When we talk about building a strong, resilient investment portfolio, the word that often comes up is diversification. Let's look at the components of a diversified portfolio and why diversification plays a critical role in managing risk and minimizing the impact of market volatility. Components of a diversified portfolio include domestic stocks, bonds, short term investments, and international stocks. Domestic stocks are shares in companies that are based in your home country. These can range from giant multinational corporations to smaller local companies. Domestic stocks include large cap, small cap, and mid cap stocks. Large cap stocks are shares in well established companies with a strong market presence. They might not provide rapid growth, but they tend to be more stable during market fluctuations. Small cap and mid cap stocks represent smaller companies that have potential for growth. They offer the potential for higher returns, but they can also be a bit more susceptible to market turbulence. Including a mix of these domestic stocks adds layers to your portfolio. While the large cap stocks provide stability, the smaller companies offer growth potential, helping to balance risk and return. Bonds are loans that you give to companies or governments in exchange for periodic interest payments, plus the return of the bond's face value when it matures. They are usually less volatile than stocks. Bond types include government bonds, corporate bonds, and municipal bonds. Government bonds are very secure. They might not provide as high a return as other types of bonds, but they add a layer of stability to your portfolio. Corporate bonds, issued by companies, offer higher potential returns, but they also come with higher risks compared to government bonds. Municipal bonds, issued by states, cities, or other local governments, often offer tax benefits, which can be an attractive feature. Bonds act like the anchors for your investment strategy, providing stability even when the stock market gets choppy. Short term investments include assets like certificates of deposit, treasury bills, and money market funds. They offer lower potential returns, but they're highly liquid and secure, providing a quick source of cash if you need it. Expanding your portfolio to include international stocks can provide access to growth in emerging markets, as well as established markets outside your home country. Investing in developed countries with established economies, like the UK or Japan, provides exposure to international growth while still maintaining a level of stability. Investing in countries with growing economies, like Brazil or India, offers higher growth potential, but they also come with higher risk due to potential political and economic instability. Why do we mix these different components together? The primary goal is to limit the impact of volatility on your portfolio. When the stock market is doing well, stocks provide great returns, but they can also drop in value very quickly during a downturn. Bonds, on the other hand, might provide lower returns, but they remain more stable during market fluctuations. By spreading your investments across different types of assets in different markets, you're not relying on any single area for your returns. If the stock market takes a hit, your bonds and short term investments can help cushion the blow. If domestic markets are struggling, international markets might be thriving. This doesn't mean you won't experience losses during extreme market conditions, but it helps reduce risk. Your portfolio won't hit the highest highs, but it also won't hit the lowest lows. It's about creating a balanced, resilient portfolio that can weather a variety of market conditions, helping you stay on course toward your long term financial goals.